Great. Well, hello, everyone. Here's a little presentation talking about real estate investment trusts. There's been some interest on the Discord channel, so we thought we would cover this. But before we get into it, Keith will read the disclaimer.
Thank you, Stuart. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Right. So real estate investment trusts, they're actually a worldwide structure. They're prominent in the US, in France, Australia, Canada. But today we're really talking about just the UK. REITs were established by a piece of legislation which came into effect in 2007. And the whole point is to simulate within a security the direct ownership of property. So a REIT must have at least 3 properties. The properties must comprise 75% of the assets of the REIT, and the profits must derive from rents. The REIT must be listed on a stock exchange and must be diversely owned, i.e., you can't just put 3 properties in just for yourself and float 10% of it. But a key thing here is that the REIT has a very distinctive tax treatment. So we're going to spend a bit of time exploring that because it has big implications. So a REIT is actually exempt from corporation tax on rental income and capital gains, which sounds pretty amazing. Other activities the REIT might undertake, which produce, for instance, interest income from cash or charges for management services, are taxed normally. So when you own a REIT, you often receive 2 types of dividend per distribution, one reflecting rental income and one reflecting profits from other activities. REIT must distribute at least 90% of the property income each year. Now that means you get very little retained profit in a REIT, and so any growth must come from issuing more equity, not from any built up of retained profits. It also means that you shouldn't particularly mistake a high yield for a low valuation. If a regular stock on a 5% yield, you might think is cheap, but for a REIT, that's effective. For a REIT that's paying out 90% of its income, that effectively means it's an 18 times price earnings ratio. And of course, if it was paying out 100% of property income, it would be a 20 times PE ratio. So REITs typically do have very high yields because they're exempt from corporation tax on their profits. Of course, this is not a free lunch. Tax is payable, but the tax is taken at the investor level, not at the corporate level.
Can I just come in there, Stuart?
Yeah.
So just to clarify, the REIT does not have to pay tax on its rental income or capital gains, but the investor presumably has to pay capital gains on the REIT.
Yes, but we'll get into one particular wrinkle that produces, but that's right.
But
now,
also, so when you say it has to pay out 90% of its income, how then does it maintain the properties?
Because the income is net of costs.
Right.
Now, of course, there would be a room for manipulation, and there would be room for lots of argument about taxation of dividends. So the government does impose a 20% withholding tax. So that's the minimum that the government is going to take from the dividend. And if you are a regular investor, you'd have to pay extra tax on top of that. Except, and that's the key next slide, at least the key as far as a UK private investor is concerned, that 20% withholding tax is reclaimable. So if you hold the REIT in an ISA or a SIP, i.e. vehicles which are tax exempt, you can reclaim that withholding tax. Now, sometimes the admin of this isn't as easy as you would hope it for it to be. Some brokers do it very smoothly and it's no problem. And in fact, for some broking accounts, I receive my REIT income gross and don't have to do anything. in my SIP, unfortunately, I have to do an end of year reclaim, pass that to the SIP administrator, and then they go and reclaim the property income distribution tax that I have, the withholding tax that was withheld at the time the dividend was initially paid. So walking that through, a typical example, say a REIT had assets of 100 and rents of 7, and typically say costs of 2, it would have a gross dividend of 5, on which the 20% withholding tax would be payable of 1, producing a net dividend of 4. But my point is that, you can receive the gross dividend. Now, I'm the sort of person who takes a slightly sort of actuarial view of this, and the idea that I can get a 5% yield, not a 4% yield, quite interests me. I think if you're Keith and you're playing the big cyclical swings between equities, bonds, and cash, it might not be quite so attractive. But to me, if you think about that as a long-term yield plus hopefully some growth, then getting that extra 1% I find quite attractive. It does, of course, mean that you want to hold the REIT, particularly in a SIP or an ISA. Obviously, there's a lot of competition for what you hold in a SIP and an ISA. Everyone wants everything to be held in a tax-free wrapper, but the high yield and the reclaimable withholding tax do make REITs, I think, a natural to hold within an ISA or a SIP. Right, so here's a look at the top holdings in the UK REIT sector. And I've sourced this from the iShares REIT ETF. There's actually, I think, about 80 different REITs. And here's just the top, I think about 20. You can see that by far the largest is Segro, then Land Securities and British Land, companies that long-term investors may be familiar with. And the scale here, by the way, is billions. So there are many, many different REITs. So just to give a flavour or an overview of the different clusters of within the UK REIT sector, there really is a huge variety. You could buy REITs which were focused on industrials, i.e., industrial parks, warehouses for industrial use. So Segro, for instance, that's what they specialise in. They used to be known as Slough Estates. There's also a REIT literally called Industrial REIT. There are student accommodation focused REITs, Unite and Empiric. There used to be a couple of others, but they got taken out, I think, by private equity companies looking to gear them up. There are retail warehouse REITs, like Tritax Big Box and Warehouse REIT, that, for instance, build and let out warehouses to people like Amazon or supermarkets or DIY companies. There are REITs focused on residential housing, that's Granger and PRS REIT. There's social housing REITs, which have been massively in the news because they're in trouble. That includes Civitas and Home REIT. And there are even property companies, REITs, that focused on surgeries, which buy and let back and let out to GPs chains of surgeries. That's Assura and Primary Health Properties.
So, Stuart, what was the controversy around social housing REITs?
Typically, they would, for instance, build care homes for disabled people or for homeless people. And the intermediary between the REIT and the ultimate client would be a housing association. But these housing associations look a bit flaky. It looks like they're not run very professionally. And the regulator of such housing associations keeps issuing warnings about their solvency because they're signing up, for instance, to CPI and RPI linked rental contracts for 25 years. So that's on their liability side. On their asset side, they're basically getting housing benefit from the government. So if they're not run professionally, there's a risk of the ultimate of the rent not being paid through to the REIT. Now, the upside there is that these things trade at massive discounts to their estimated net asset value, which obviously calls into question the net asset value calculation. but there's a huge margin of safety to the current valuation of those social housing REITs. Now, what I learned in looking at REITs is that there's something called EPRA, and it's your friend. It does a lot of calculations for you that you really do need to do to understand the financial performance of a REIT. So EPRA stands for the European Public Real Estate Association. Now, there's a lot of room when you look through the statements of property companies for creative accounting, for gaming, etc. So this is an attempt to try to put the measures on a level playing field. So I've highlighted 6 that in particular I focus on for each of the REITs that I look at. So the simplest measure is earnings, because that's the fundamental driver of what dividend is payable. Now this, the EPRA measure focuses on the operating profits, i.e., rents minus costs, minus finance charges. That's what you've got left to pay out the dividend. Now that's different from IFRS earnings, and you might normally want to trust IFRS earnings. But IFRS earnings include asset rate revaluation profits. So the EPRA earnings are, in a sense, the operational profit, what you could afford to pay out, separate from the ups and downs of the property valuation changes. The next measure I look at is the net asset value, so the fair value of assets, and that, of course, is a vital anchor valuation. And often this is based really on what surveyors have done, what they've analysed to be the asset value. So when the accounts are done, you might you call on any of these different surveyors to go out and value a business, value a property. And typically what they're going to do is to capitalise the rent that property generates. And the capitalisation rate, they'll basically look at activity in the market to see what similar properties have been valued on. There's triple net asset value. That's where you take the standard net asset value, but you take off the current value of debt and deferred taxation. A lot of the REITs have substantial debt profiles, of course, and that the value of that debt at market values can change as interest rates change. So if you raised 100 million, you could just take 100 million off your net asset value each year, or you could take off the current market value of that debt, which would change with interest rates. There's also the issue of deferred taxation, so that also affects in a sense, the realizable net asset value. The next measure is the one that I've got hugely wrong this year and didn't pay enough attention to, which is the net income yield, which is the annualized rent divided by the asset value. So in a sense, you can think of this as a comparison with a bond. Now, my mistake was, for instance, to look at some of the warehouse REITs, which were let to people like Amazon. And I thought, well, that's about as good a counterparty as you're ever going to get. This is definitely a rental stream that you could capitalize with very little adjustment to the discount rate. And I thought, that's great. They've signed some RPI or CPI linked annual rent increase from Amazon. That looks very attractive compared to, say, an index linked bond. I'll have it. I'll have that stock. But that meant that even when the net income yield was down to 3.5 or 4%, I didn't pay enough attention to the fact that that could easily move to 4, 4.5, 5% as long bonds sold off. So that's been the hit that I've taken this year, not paying enough attention to net income yield. The next EPRA valuation measure to pay attention to is the vacancy rate. So obviously a measure of unused assets, and this is typically estimated based on what the rental value of an unoccupied property would be. Now, sometimes you want 100% occupancy. Sometimes actually the opportunity is in something which doesn't have very high occupancy, perhaps 80 or 85%, if you believe the cycle is turning, or if you believe the management has got a plan to get those properties occupied. The final very helpful valuation measure that EPRA produce is the cost ratio. So administration and operating costs divided by gross rent. And when I first started looking at this sector, I was hoping, in a sense, for a much easier version of a buy-to-let property where you just buy a REIT. The whole point of a REIT is to synthesize direct ownership of a property. And I couldn't believe just how much of the rent dribbled away in admin and operating costs. I've definitely seen cases of 35% cost ratio. And that happened in particular in some of the European logistics REITs, where they were buying properties because rates were so low in Europe. They were buying properties on net income yields of about 2.8%. And then you lost a third of the income in the operating costs. The attraction was that they were able to borrow at less than 1%. So they were still making a bit of a spread, but it was completely vulnerable to the regime change in rates, which we saw last year. Now, I believe that the REITs are always obliged to produce these measures. Sometimes they're hidden in the back of the annual report, but do look out for them. It's standardized. They attempt to avoid accounting gaming. And I think if you begin to look at these over time and between different REITs, you get a sense of the state of the market. Now, turning to the current issues in the REIT market, the chart here tells a very important story. It's the 10-year UK gilt yield, which has gone, as I think we all know, from under 1% to 3.5%, 4%, with a very sharp change during 2022. Now, that has been the real cause of a valuation cascade in the REIT sector. So higher inflation has led to higher bond yields. Higher bond yields has required a higher net income yield, and therefore a big reduction in net asset value. So by and large, if we think about the net income yield calculation, the rent, the numerator, hasn't changed much. By and large, rents have gone up and gone up tidily, but the denominator has gone down to produce the higher net income yield. And that income yield, of course, is required by higher bond yields. There's obviously, of course, an increased focus on recession and vacancies, though that I'd say that is very definitely a second order effect. It's really mainly about the change in bond yields. Debt profiles, I think, are very interesting. A couple of the REITs that I own because they took out very long, low interest rate debt. So Schroeder REIT, for instance, they have got, I think, 12-year fixed rate debt at about 2.5%. So in my mind, REITs like that are interesting because, let's say, as an approximation, their rents go up in line with something like inflation over 12 years, but their debt interest payments do not. You gradually build a big wedge between rent and finance cost. A fourth issue very much to be aware of is increased environmental requirements. I think we're all aware from our own properties that there's something called the EPC certificate, Energy Performance Certificate, and buy-to-let landlords, for instance, have to upgrade their properties for certain environmental standards, and the same is happening in the office market. And second and third order offices, for instance, seem to be almost unlettable. So there's been a massive shift in the profile of desired property. And of course, that's exacerbated with work from home effects. So the only real places to hide are sort of shared office space or very modern offices on long-term leases. A final issue that is of interest to me is the issue of rental growth profiles. Some REITs have an extensive portfolio of tenants who've signed up to CPI-linked rental increases. Most others have got open market reviews. Now, these can be annual or they can be 5-year, but there's a very different profile. If you're invested in a REIT whose tenants have got CPI links, are often very long-term ones, what you're interested in is really the financial risk of the counterparty. Open market reviews are much more traditional. That's the current state of the market.
So, Stu, can you just explain what an open market review is?
Basically, what do similar properties let at? If the market has become a lot weaker, and I was a tenant, I would argue, no, I'm not going to pay any rental increase. In fact, I want a rental reduction. Conversely, if a market is hot, as a couple of years ago, logistics warehouses were, then the REIT would really jam up the rent massively. So it's really what the open market rental level would be, whereas the CPI link is pretty much what it says. You sign up to a contract with typically annual and typically capped and collared rental increases. So I thought I'd run through a few examples because they are live. They're mostly from my portfolio. Here's the chart of the performance of Tritax Big Box. It produces huge warehouses for people like Amazon and supermarkets and DIY companies. So huge warehouses and reasonably high quality tenants. It has just over half of its rental book on RPI or CPI linked annual reviews. So we can see the performance in the bottom right here, and it was trundling along perfectly nicely between 2014 and 2019. Share price went from £1 to £1.40, plus you're getting 4 or 5% a year dividend, so a typical Stuart type stock. Then things went ballistic in 2021 with low rates and the absolute dash for yield, and the stock peaked out at £2.40. And at the time of this chart, it was back to about £1.40. I think it's changed over the past few days. It's more like £1.50 at the moment. But you can see a big ramp up and an equally abrupt collapse. So running through some of the valuation measures and what's been happening, well, the claimed net asset value is £2.23 against the current market price of £1.40, £1.50. So the price to book is about 0.6, i.e. a 40% discount to book value. So on the surface, this looks interesting. However, and this is a prime example of the mistake I made, in that to get the net asset value of £2.23, the assets, the rental stream was valued using a net income yield of just 3.6%. Now, obviously, the next time the valuers go and value the properties, there's no way the net income yield is going to be 3.6%, given that's what are UK gilts at the moment, Keith? Something like that?
There's something like 3.6%, yes.
Yeah, so that they're going to have to be valued at 4.65% net income yield to give some premium over gilts. The debt to gross assets about 25%, so not too highly geared. The debt maturity averages about 6.5 years, capped at just 2.5%. So for the next few years and through the recession, they would seem to be financially, you wouldn't worry too much. The quality of the tenants looks good. They haven't got any big debt maturity to topple them over. The cost ratio is very attractive compared to most other REITs, about 14% and no vacancies. So on a current dividend of 6.7p, you're getting a 4.8% yield, which, if you believe the Amazon are going to keep paying an RPI or CPI linked rent, you would hope that yield could grow gradually. That's at the current market price, not at the net asset value. Any interest, Keith? Would that tempt you?
Well, what I really like is the fact that it's got debt capped at 2.5%, and as you say, the rents growing at CPI, and we know we've had CPI 11% this year, the peak. So you are getting a real increase in the NAV of these companies, just through the finances, the fact they've locked in very low debt costs. Whether right now is the time to buy or not, I would question. I think that, okay, so far there hasn't been an increase in the vacancy rate, but I think we are going to go into a recession. And I mean, in the case of Tritax Big Box, where most of the renters are big companies like Amazon, I think you're probably safe. But in some of the other ones, I would be concerned.
Yeah, very good point. Okay, let's turn to another example. This is LXI REIT. Now, this one I've chosen because it's the absolute exemplar of a company that has locked in almost all its tenancies onto RPI or CPI linked fixed or increases. So they've got a massive portfolio of hotels, theme parks, care homes, etc. If you believe the net asset value, the net asset value is 143 and the current share price is about 112. So it's on about a 20% discount to that NAV. Now, the NAV was calculated by capitalizing the rents at 4.5% net income yield. Now, there's something called the topped up net income yield, which is the net income yield if you exclude all the initial discounts and savings and bonuses that sometimes a REIT will offer to a tenant. And it's to some extent a measure of what the open market yield might be after those incentives expire. The debt to gross assets, just 22%. The average debt maturity on this one is 12 years. Tritax was 6 years. So they know their stuff when it comes to, in a sense, the financial engineering, and that's fixed at 2.85% for 12 years. Conversely, the rents should be increasing each year by RPI or CPI. Now, just on that, it's not always clear in the accounts, but many of these RPI or CPI linked rental increase contracts have caps and collars on them. So the annual rent increase might be capped at 4 or 5% and collared at 1%. So even though we've had RPI and CPI of sort of 14 and 11%, you're not going to get that each year. You're going to get capped out. Now, LXI, I think, is pretty well run. The cost to rent ratio, about 16%, is pretty good. No vacancies. A dividend of 6p gives you a yield of 5.2%. And I think this is a good example of the wedge argument where there's an increased wedge between growing rental and fixed cost of debt, at least. So this one, to me, looks quite interesting. It's sold off hard from about the high 140s to about just over £1.10 at the moment. I think it's worth a look at.
It's actually, the share price has been much less volatile than Tritax Big Box. The Tritax Big Box basically doubled for between the pandemic and, peak in late 21, and this has come off by what, 30%?
True. Well, I think we've spoken offline before, haven't we, Keith, about the bubble in warehouses, and I think Tritax has shown that in spades.
And this should presumably be more pro-cyclical than Tritax, because the hotels and theme parks, you can imagine, if we go into a recession and consumers cut back on their spending, then those are some of the activities they are likely to cut first. Yes,
so that's why you have to have some comfort with the counterparty risk, because the operators of the hotels and theme parks, they're on the hook for the rent come what may. It's not a revenue related rent. There it is. Each year it increases.
Unless they go bust.
Right, here's example 3, Home REIT, and this is an example of the social housing REIT and either the absolute nightmare or the wonderful opportunity, depending on your perspective and what happens. So Home REIT provides accommodation to the homeless. It has RPI-linked rents via housing associations, and housing associations get their revenue from housing benefit. It's been subject of a short attack, and you can see that very clearly in the share price, which has collapsed from almost £1.20 to 40p. Now, the nature of the short attack is to argue that Home REIT has been buying accommodation for the homeless from property developers, and those property developers have been funding the housing association's rent. So the argument is that there isn't the underlying revenue. It's in a sense some form of vendor financing where the property developer has given the housing association money to pay the rent. There's also some suspicion that the housing associations seem to have a bit of an overlap with the property developers in terms of personnel. Doesn't smell good. Having said that, the extent of the number of housing associations where that is the accusation, to me, doesn't seem to be even half the portfolio. To me, it looks more like about 15% of the portfolio. But the stock is suspended at the moment because they haven't produced their latest report and accounts, because they're doing a deep dive audit and they want to come out with a totally clean set of accounts dealing with all the issues that the short seller has attended to. The last stated net asset value was £1.11, and as I say, the stock is trading about 40p, so it's on a 65% discount to net asset value. The properties don't appear to be aggressively valued. The rents were being capitalized at a net income yield of 5.9%. So that, you would on the surface think, well, that doesn't seem like the properties are being wildly overpriced. The debt to gross assets is a bit higher than the previous two we looked at 35%. But the financial profile looks good to me in the sense that the average debt maturity is 11 years and they've got it all fixed at 2.3%. Costs are about 20% of revenues. There's no vacancies. And if they maintained the dividend, then you're buying at a 14% yield. So it's to some extent a knife edge stock. It depends how the market takes the report and accounts when they're finally published, and how much credence you put in the valuation that the surveyors will come out with for the annual report. But it does seem to me there's a huge margin of safety built into this. And I can imagine there are many fund managers who just, in a sense, had to get out, short attack, report and accounts, suspend, delayed, don't want to know, this smells, I'm out of here. But if you think through, ultimately, you've got homeless people, you've got accommodation. The homeless, the accommodation is, I think, works out, around 120 quid a week. It's much cheaper than many other solutions to homelessness. The problem is all around these housing associations and how they're run. But if you think that ultimately the rents are going to flow through to the property owner and are backed by housing benefit, you could say, well, look, the one advantage a private investor has, which is you can be long-term about things, makes this, I think, an interesting punt.
Yeah, that looks interesting. So much depends on the accounts and what the investigation finds. I would be interested to see what happens to the share price when it comes out of suspension, and I will put it on my watch list, Stuart.
But also a lesson to us all, as Keith has been stressing in the past few portfolio matters, equities can be risky. You can lose a lot, and this one certainly did. Example 4, PRS REIT. This one I found quite sort of just personally interesting. It stands for Private Rental Sector REIT. And it was set up, I think, initially also with some government money. And the idea was that the REIT would build using prefab houses to have economies of scale. It would build housing for people at an affordable rent. So a monthly 3-bedroom house, for instance, might be about 800 quid rent. So this is typically not in the southeast of England. This is elsewhere where land is cheaper and where they get the advantage of, hopefully, modular construction to build these houses. Again, it's another company with RPI or CPI linked rental contracts. Almost all their rent is on that basis. Now, this stock hasn't collapsed anything like the same amount as other REITs. It's fallen from about £1.05 to about 90p. Now, the net asset value is estimated at 116p, as I say, compared to about 90p share price. So you're getting it at about a 25% discount to the last calculated net asset value. That net asset value, however, was capitalizing the rents at just a 4.1% yield. So arguably, that was a little bit racy for a not particularly interesting subsector of the market. Debt to gross assets about 31%. Average debt maturity 17 years, fixed at 2.9%. So you can tell from my voice, that's again the sort of thing that I like. It's another wedge stock where the financing looks attractively locked in for the long term. Cost to rents about 18%, not great, but not awful. Almost no vacancies. These properties are snapped up the instant they become available. And the last annual dividend is about 4p, so about a 4.5% yield on a 90p share price. Can I tempt you, Keith? Any interest in that one?
Actually, Stuart, you are convincing me of the whole sector. Because essentially these are like index-linked bonds. If they have good customers like renters, then you're getting essentially RPI plus 4.5%.
Well, you should be. My battle-hardened experience is that, for instance, PRS REIT hasn't increased its dividend yet because it's been rolling out its portfolio. It's been building it for the past few years. But they're about, I think, 95% done in building their initial portfolio. So me being me, I'd rather they just sat on their hands now and just picked up higher rents and paid out a higher dividend. I suspect because they've got some sense of social purpose, they might be capital raising and they might continue to grow the portfolio. Now, if you grow a portfolio at 5-10% a year, I've got no problem with that. It's when you start growing 15-20% a year that the focus of the business doesn't really become, I think, paying out an increased dividend. It becomes growing the business.
Yeah.
So I've got a little portfolio of these RPI, CPI linked things to try to get that overall index linked rental increase into the dividend, but I wouldn't bet on it on any individual REIT's case.
Now, what happened to all these REITs prior to January 2020, i.e. the pandemic, because their NAV was their share price was coming off?
Well, certainly was with PRS REIT, and I think there was some delay in the build out of their estate. But if we flick back, let's see if the others have the same profile. Home REIT's rather different. LXI, that was doing rather nicely prior to the pandemic, wasn't it? It's really the pandemic that knocked it in 2020 before it bounced back. And Tritax, not so much. So I don't think it was across the board, Keith, just in the case of Home REIT. So you're beginning to have some interest in the area, Keith?
No, I am. I mean, not yet, frankly, in that, as you discussed earlier, I think this is a play both on the cycle, depending on what the actual properties are, and also on the interest rate cycle. And as you know, Stuart, I have got the interest rate cycle wrong. And the moment it has convincingly peaked, I actually would be quite interested in this.
Yep.
But I don't think that's quite yet. Having been burnt, I'm very much sitting on my hands at the moment.
I think you put it very well. It's that trade-off, isn't it, between the cyclical effect on rents and the effect of lower long-term bond yields. So in summary, REITs, well, it's a real asset exposure and you're getting a decent yield at the moment. The tax structure makes them ideally suited to holding in SIPs and ISAs, but the big judgment is valuation. The headwinds are any further increase in bond yields and the cyclical risks to vacancies, but the tailwinds are some pretty chunky discounts and in the background, quiet rental inflation.
Great. Well, thank you, Stuart. I, for one, will be keeping an eye on Home REIT when its annual accounts are finally published. I hope you all found that interesting. Thank you to Stuart Owen for sharing his experience once again. Thank you for watching through to the end. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Stuart Owen.
And goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.